You know that classic physics experiment where a massive steel spring is compressed by a hydraulic press?
Oh, yeah, where you just keep adding weight and looks totally static on the outside.
Right, exactly. But underneath, the potential energy is just, screaming for a release valve.
Yeah, it's just waiting to snap.
Well, welcome to today's deep dive into the July 2026 Bitcoin Digest. Because today we're looking at a market that spent the last week acting exactly like that compressed spring.
Right.
And I mean, over the last 24 hours, the press basically slipped. We are tracking this wild collision of macro shifts, aggressive infrastructure builds, and tightening regulations.
Yeah, it's a lot to unpack.
It is. But honestly, it is all pointing to one overarching theme for you to watch today, which is the great assimilation of crypto into traditional finance. It's happening right under our noses.
It really is. I mean, that release of pressure yesterday was violent.
Yeah.
We saw a complete inversion of the market's momentum in just, what, a matter of hours?
Yeah, let's unpack that 24-hour price action because we had this massive $4.4 billion supply overhang pressing the market down.
Right, the hydraulic press.
Exactly. And yesterday morning, early selling forces the price to an intraday low of $58,242. And late-stage short speculators clearly thought the floor was falling out.
But they totally miscalculated the underlying demand. I mean, high-frequency spot buyers just stepped in to absorb all of that selling pressure.
Wow.
Yeah, so when the price didn't break down, those late shorts had to buy back their positions to cover their losses. And that triggered a brutal short squeeze.
Like, how brutal are we talking?
Over $300 million in short positions liquidated in hours. It just rocketed the price right back over $61,000.
So, I mean, looking at the charts, it looks like the release valve wasn't even crypto native. It was entirely macro.
Oh, absolutely.
Because Fed Chair Kevin Warsh essentially blinked over in Sintra, didn't he? I mean, he flat out said domestic inflation risks are fading.
Yeah, he did. And if you combine that rhetorical shift with the massive ADP jobs missed.
Oh, right. It was only 98,000 private jobs added in June, right? Versus the 110,000 expected.
Exactly. So the market instantly priced in imminent monetary easing. When the Fed signals a pivot like that, the opportunity cost of holding non-yielding assets just drops.
Which lifts both Bitcoin and gold simultaneously.
Right. That was the catalyst.
Well, you call it a pivot, but I mean, if you look at institutional flows, I'd say the institutional thesis looks practically dead right now.
How so?
Well, June saw $4.5 billion bleed out of spot ETFs. Strategy Inc.'s equity dropped 41%. And American Bitcoin Corp, ABTC, is doing a 1-for-15 reverse stock split.
Yeah, that's rough.
Right. They're basically artificially inflating their share price just to avoid getting delisted from the NASDAQ. So if institutional capital is bleeding out, why are retail platforms still building so aggressively?
Because it only looks grim on the surface. You're ignoring the plumbing being built underneath. Like, yes, traditional capital is de-risking, but retail giants are building massive frictionless infrastructure right now.
Okay, give me an example.
Look at Robinhood in London. They didn't just add trading. They launched their own Layer 2 network, the Robinhood Chain, with zero gas fees.
Wait, literally zero?
Literally zero. By removing network transaction costs entirely, they can integrate 2047 tokenized stock trading. Plus, they're offering 7% yields on stablecoins. They are bypassing traditional banking constraints entirely.
Okay, that makes sense. So by cutting out the friction, they're turning it from a speculative asset into everyday financial plumbing.
Exactly. And they aren't the only ones. You've got Solana's world prediction market tapping directly into 20 million Phantom Wallet users.
Right. And STBL just launched a treasury-backed stablecoin natively on Stellar.
Yeah, so the building hasn't stopped. Even the mining sector isn't universally suffering. While ABTC dilutes shares, hybrid operators like Hyperscale Data are thriving. They just used alternative AI hosting revenues to buy another 67 Bitcoin.
Wow, okay. But I mean, when you have retail giants building infrastructure that actually threatens traditional banking models, regulators aren't just going to sit back and watch.
Oh, definitely not.
Yeah?
They are aggressively stepping in to build fences.
Right. Which brings us to the tightening regulatory perimeter globally. Australia just finalized a strict no minimum threshold travel rule.
Yeah, that's a big deal. The days of anonymous transfers there are basically over.
Completely. Exchanges now have to attach your verified identity data to every single transaction, even if you're just, sending funds to your own hardware wallet in a desk drawer.
And meanwhile, Taiwan just introduced up to 10 years in prison for market manipulation.
10 years?
Yeah, they aren't playing around.
which is such a stark contrast to the U.S. landscape. Here, the focus is less on strict surveillance and more on just deep political entanglement.
Right.
Analytically speaking, we just saw Donald Trump's mandatory financial disclosure reveal over $1.4 billion generated from proprietary crypto ventures.
That's a massive number.
It is. It includes token sales and likeness licensing. It shows staggering political integration, though, it is worth noting that tokens linked to his World Liberty Financial Project have dropped 80% on secondary markets.
Yeah, it highlights a very unique domestic posture. High-profile figures are deeply embedded in the market's evolution here, rather than just regulating it from the outside like in Taiwan or Australia.
Exactly. So what does this all mean for you right now? Keep your eyes locked on the upcoming official U.S. employment report.
Definitely. If it confirms that ADP jobs miss, it could cement that macro pivot from the Fed.
Right. And of course, watch to see if those billions in ETF outflows finally reverse.
The macro winds always dictate the next move.
They always do. And it leaves us with this final thought. With traditional brokers launching their own blockchains and global regulations demanding verified identity on literally every transaction, are we witnessing the maturation of decentralized finance or just its total assimilation into the traditional financial machine?
It's a great question.
Something to think about. Keep an eye on the hydraulic press, everyone. We'll see you next time.